Welcome to Talking Industrial Automation, a podcast where you get to know the people who make modern industrial automation possible. You will get to hear from CSIA system integrators and industry partners to get a better understanding of how they help their clients solve process challenges and how they've earned success in their careers. Along the way, we will touch on system integration best practices, technology, trends, and challenges. Whether you are a manufacturer, end user, supplier, or system integrator, you will enjoy the insights these industry professionals bring to this podcast. Let's get started. Hi, my name is Lisa Richter, the host of Talking Industrial Automation, a podcast where you get to know the people who make modern industrial automation and processing possible. In today's episode, we're doing something a little different by covering a topic that we wouldn't normally get into, and that's taxes. I know. It's not everyone's cup of tea. But with so much that happened in 2020 that impacted businesses like the CARES Act and Paycheck Protection Program, we felt it was worth spending a little time delving into the implications and obligations as we army crawl over the 2020 finish line. With me today to help us do that is Tim Finerty, a shareholder with Clayton and McKervey, a tax and advisory firm in Southfield, Michigan, which is focused on growth-oriented entrepreneurial businesses. Tim heads up the company's industrial automation sector. Tim, welcome to the podcast.
Thanks for having me, Lisa.
To get started, help me understand why it is so important for business owners and their financial teams to tax plan in 2020 compared to maybe another year.
Lisa, that's a great question. It's really important this year because there's so many different things that are out there. We started with a few years ago the Tax Cuts and Jobs Act of 2017. The CARES Act was put into place this year, which you mentioned a little bit had to do with the Paycheck Protection Program. And then there's some different things within that PPP program that relates to the loan forgiveness, taxability, deductibility, and maybe how that impacts the R&D credits as well. And then we have currently a proposed new stimulus bill that could have a few things that we probably need to touch on. And then finally, we probably want to dive in and understand what might be coming down that pipeline under the Biden tax plan.
Okay, so let's tackle some of that. What do people need to know about the CARES Act?
Well, so the CARES Act, a lot of people know that the PPP loans were part of that. But there's a few things that really stick out that people need to better understand what's in there. One of the things that they did was they did a 5-year NOL carryback. The NOLs is net operating losses. So if you created some sort of net operating loss in the current year, you could potentially carry it back 5 years. They also made a change to allow for 15-year property that was previously under the Tax Cuts and Jobs Act that you couldn't take bonus depreciation on. So now if people are doing leasehold improvements or different things like that, they could potentially take 100% of that bonus depreciation, which then gets back a little bit to the net operating losses. And then they got rid of another item that was caused by the Tax Cuts and Jobs Act, which is the business loss limitation. So before, if a business created a loss of $1 million and for some reason had owners took $750,000 in income, they could only offset $500,000 of that loss. So they'd still be paying some tax on their losses. So there was a limitation that then got rid of.
Tell me more about the impact of net operating loss carrybacks.
Mentioned just before, right? The 5-year carryback, it's really an interesting opportunity for a lot of businesses. So under the Tax Cuts and Jobs Act of 2017, there was a few things that happened, which was the 100% bonus depreciation. So if you're thinking about buying a piece of new equipment, anything like that will help the company be more successful in the future, it could be an awesome time to try to get that done before the end of the year, where you could take 100% bonus depreciation. So for example, let's say we wanted to buy a $500,000 piece of equipment. We could take that entire $500,000 as depreciation against our income. And then also in that Tax Cuts and Jobs Act, for any companies under $25 million in revenue, you can potentially, if you haven't already done it, change from a accrual basis taxpayer to a cash basis taxpayer. And with that, you could potentially create additional deductions that are out there to create an NOL. So for example, if I had $1 million of book income to start with, I bought this piece of equipment, I could depreciate it $500,000, so I'd be at $500,000 of income. But if I did a cash accrual to cash adjustment, let's just say I had $1.5 million accrual to cash adjustment, meaning I had a ton of receivables compared to where my payables were, and offset that. Therefore, I created $1 million tax loss in this scenario that I just gave. I could take that $1 million, take it back 5 years to a year maybe I was really profitable and paid at the highest tax level and ask for that money back. So it really creates a huge opportunity if we're doing some tax planning to understand why we would want to do that.
So if a company creates net operating losses for 2020, why should they care about R&D credit?
A couple things there is, so for example, in the last example I gave, if I was able to carry back that loss, that means in the current year, I didn't have a loss or I didn't have any income, so I wouldn't be able to use my R&D credits. However, the R&D credits are automatically carried back 1 year. So if 2019 was a really good year, I could carry back those credits and use them to offset taxes that I already paid. So now I'm kind of double dipping, which is an awesome, cash flow idea. And when you file your 20 return and you do this automatic carryback, the cash coming back gets back to you much quicker. And then the other thing is, so this NOL that we talked about briefly before doesn't always impact, some of these things don't always impact the states. And so you might have some state taxes, but about 35 of the states have research and development tax credits. And some of those states also have refundable credits. You really need to look at it and figure out what makes the most sense.
I don't know about you, but I am so over 2020. And I am so ready to dig into 2021 and roll out all the new value CSIA has planned for system integrators and vendor partners next year. If you haven't heard, we've completely revamped our content delivery strategy for 2021 to include weekly virtual events that will continue the CSIA tradition of knowledge sharing, community building, and networking, but also capitalize on the opportunities and innovation digital delivery offers. The best part is, this online strategy means anyone from your company, from the newbies to the seasoned pros, will have access to education and content that would normally be out of reach. And don't worry, we still have the other goodies that come with membership, including the highly valued best practices, professional services discounts, benchmarking, training, and a completely revamped marketing toolbox. All this with no dues increase over 2020. To learn more, visit www.controlsys.org/join-2021. Let's do this.
So you mentioned that some states have R&D credits that are refundable. Can you tell me a little bit more about that?
So different states really look at what you're doing from a research and development credit. And, I'll take an example that we recently did is Arizona. So Arizona's got a really nice refundable credit. Basically, if you calculate your federal credit and say it was $200,000, you're going to effectively get about a $200,000 Arizona tax credit. Well, the state income tax isn't as high as the federal income tax, so you may not use all of it, and you'd have a lot carried over. Well, in that situation, there's opportunities to say, okay, let's manage 1 year that we want a refundable. The next year we want to use it against our tax and then carry it forward for future. Because what you want to do long term too is really plan out how you're going to use some of these credits. And these credits can also be used on sale. So when you sell the company or have a big thing, you can use any unused credits against your federal tax liabilities and your state tax liabilities during those years.
knowing my audience, which is a bunch of engineers, they like to really DIY stuff, right? They like to get on YouTube or figure out how to do stuff themselves. Is this tax planning something they should try and do on their own? Or do you feel like it's a topic that's just too complicated or there's too many nuances to really be able to recommend that?
Yeah, I mean, I can't even do it on my own. I have a team of 70 people in our office, and I have to go to certain ones, for certain things because I can't be an expert in everything. And so, yes, it is very important, I think, to make sure that you're looking at these opportunities, because every opportunity right now is a cash savings opportunity to put more money in your pocket. I think a lot of the members have found out that with this pandemic, you just never know what happens in a year, and cash is king. And so if you're doing some of these things that you can set out now to really be better in the future, or to keep more cash in the business to reinvest and do other things, it really makes it a huge opportunity to plan. I mean, there's a lot of different ways to do it. And so, yes, I would say that you want to talk to your current tax provider to go through some of these things. But in certain issues, like when you're talking about R&D tax credits, it's hard to, if you're using a specialty tax firm or some other things, really it's both parties have to get together to understand how it's going to impact. And I think that's where, one of the benefits that we've tried to do, and one of the reasons we've put in a focus on the R&D credits, is to truly understand and see the impact of what it is to the system integrators, right? Trying to have them be able to go to a one-stop shop of just being able to say, okay, if I call Tim, he's going to help me with these different things. One of the big items right now that we just kind of were talking about is the Paycheck Protection Program. The loan forgiveness right now is the expenses against that loan forgiveness. If you feel like you're going to get the loan forgiveness, under the current way that the code is written, are not deductible. So you're going to pick up additional income for that. A lot of the things, too, that could cause some problems there is if you've been taking, an R&D credit and most of your wages are engineering wages and you're using this Paycheck protection, those wages potentially won't qualify. But under the new scenario where you got the option to take 8 weeks or 24 weeks, you may be able to look at how we're applying wages. So you could use wages that are not for certain people that are doing research credits, so you don't reduce your research credit in that situation.
What are some other key year-end planning matters people should think about?
Yeah, so we just talked about the PPP loan, which is a huge one. I think that the other big thing is, for some of my smaller clients, depending on what's happening with total wages that they have and income, you want to look at how do I maximize my QBI, which is my qualified business income. Because what that does is if I'm a flow-through entity and I give myself $1 million salary, let's just say, I'm going to pay at 37% on that salary. Well, if I was able to, really my salary should be, about $250,000, and the rest of the income flowing through is just income from the activity, that $750,000 can be applied against QBI if it hits the qualifications and reduces your tax rate from like 37% down to 30%. So you really want to look at how to maximize your QBI. So that's one thing. Individually, there's a few things that I think are pretty important that people need to look at. Some of these owners are different things. Maybe there's a reason that to take out some money up to $100,000 in your retirement fund. There's under the CARES Act, basically, they eliminated the early distribution penalties on that. And you have up to 3 years to pay the tax on it, but you potentially could put the money back later on. So then you wouldn't have any tax. So that's a nice little potential if you put away some good money, but you want to have access to it without having to pay that 10% penalty. There's an opportunity for owners to look at something like that. Charitable contributions, sometimes it was limited to the 60% of your total income. If for some reason you had an event and you really wanted to put a lot more away or something like that, you could start donor advised fund. That money would go in there and then you could put it out to certain charities in the future, but it could really save some taxes right now if you had the cash and wanted to give to charity at this time. I have a couple clients that had some transactions that are taking advantage of, now got rid of not having to look at where your adjusted gross income is, that it limits it on that. So that's one thing. Another interesting one that's out there that really hasn't had a whole lot of talk about is this employer education payment. If I was going to give bonuses to some of my employees, but a lot of them had student loans or different things like that, I could give a non-taxable bonus for these employee education payments for $5,250 per employee. So if I got a $10,000 bonus, I could take $5,000 of it and just use it, give it to an employee that they could pay down student loan debt, without having to pay tax on it. So it's a nice little benefit that create and get rid of some of the student loans on there. So those are kind of the big things, other additional planning things that we would suggest looking at.
With so many people working from home, canceling in-person meetings and events, and spending more and more time online, it's more important than ever that your digital presence is top-notch and that you find creative ways to maximize your marketing resources and get in front of your customers. The Industrial Automation Exchange and the Talking Industrial Automation podcast are the perfect places to start. The Exchange offers upgrades, packages, and display opportunities to ensure your brand is top of mind during your customers' complicated, research-based buying journey. The Talking Industrial Automation podcast can also help because now you can place your 60-second spot into the podcast. It's super easy and a unique way to reach new audiences. To learn more about the packages and advertising opportunities or how to become a podcast sponsor, contact me, Lisa Richter, at industrydir@controlsys.org. Let's face it, it's a digital world out there, and you need to make sure your company doesn't get left behind. Let the Exchange and podcast go to work for you.
You talked about the R&D credit a lot, but why should a company file timely every year?
Yeah, so there's a couple reasons why. So there's under the R&D credit scenarios, when you look at it, there's two different methods that are out there. There's the regular credit method, and there's the alternative simplified credit method. And if you do it timely each year, you can take advantage of either one of them. And what I mean by that is, as you're going through it and you do the calculation, it could change year to year based off of what qualifies and what doesn't qualify, of which method is better to use. For example, we had a client this past year that we had taken the regular credit in a previous year, and then we kind of passed on doing the credits for 3 years. We made the election to do it, but under that scenario, we weren't able. One of the years we would have created more credit under the alternative simplified method. In this case, it didn't cost that much, but it could be significant when you're looking at it. So you want to do that. Plus, the nice thing about doing the credits each year is that you're not doing amended returns, which sometimes then open up more opportunities. But a lot of times, too, is the state credits. A lot of people forget about the state credits. Sometimes you don't pay as much in federal. You're portioning out different things to states. So you want to keep those state credits out there. And I just think it's a much easier plan to get it done on an annual basis.
Finally, let's talk about President-elect Biden's tax plan. What can we expect?
He's put out kind of some different things that have, I think, made some of our entrepreneurs a little nervous of what could happen in the future. So I'll briefly go through that and then maybe give my opinion on where I think certain things might be. He wants to take the corporate tax rate, which is at 21% right now, to 28%. And also, I believe the way that it's worded is impose a minimum tax of 15% on any corporations with more than 100 million in book profits. Now, not many of the CSIA clients are going to be at that amount, but I think that eliminates, meaning that if you were able to take your federal tax down below that 15% for, because you had R&D credits or different things, potentially you'd still have to pay at that 15%. level. But one of the big things that he's doing, and exactly how it's going to be calculated, if it's on W-2 or if it's on flow-through income, we're not exactly sure. But he's planning on imposing a 12.4 Social Security payroll tax on income earned over $400,000. So right now, you basically cap out of your Social Security at like $135,000. So what he's proposing is if you got income over 400, you're going to now have to pay again at that 12.4%. Basically pay that 12.4 up to 135, and then you just pay the Medicare, which is another 2.9%. And really, this is both the employer portion and the employee portion. Employers, if they had people that made over 400,000, are then going to be required, I believe, potentially to pay a little bit more on their side as well. So that's one thing that we have to look at. And then also, he's planning on repealing that 20% QBI, that qualified business income deduction for owners on the pass-through entities. He's planning on increasing the top individual tax rates from 37% back up to 39.6%. Now, a few of the things that we think he might be doing is for some of the larger states like New York or California, they put limitations on your state income tax and property tax limitation at $10,000, well, for everybody, but they were impacted more. He may be getting rid of that. It may be somewhat of a wash at that level. But again, that QBI is that key thing that's getting eliminated. And then another big item is he's talking about eliminating the capital gain tax at the 20% rate up to go back to 39.6 rate, the highest tax individual rate, on any capital gains over $1 million. You know, what then happens there is for some of the companies that are looking at a potential sale down the road, if that sale is going to be over $1 million, you may be paying at normal ordinary income rate. So you're paying at 40% on the $1 million that you had. So you're taking home you're paying 100% more tax than what you did previously on some of that. So a few of my clients were looking at, should I try to sell my company this year if we're getting close? How do I do that? Should I get out of some of my long-term portfolio, take capital gains there? Some of that stuff question is, when is this going to get impacted by Biden? And we're not completely sure. And I think if we hope that Georgia retains at least one seat in the Senate as Republican, he's going to have a tough time passing any tax plan, at least for 2 years. So that's a good thing. The other big item that a lot of people don't think about, because it only happens upon an individual's death, is he's looking at eliminating the step up in basis on inherited property. So for example, if your company that you have is valued at, the basis in it is, let's just say, $100,000. If upon your death, you die, you get a valuation and the company's basis now is $5 million, you get a step up in basis and wouldn't have to pay tax on that difference. You sell it, you'd have to pay tax. And so that inherited step up in basis is a huge item for gifting and estate planning. So it's something that, if he eliminates it, it really is, a lot of people are going to have bigger tax bills upon death. And then he's also thinking about reducing the current estate tax gifting, which is really over $11 million per individual, or about $23 million with inflation for spouses and with included your spouse. So he's thinking about taking it down to about $7 million. So it totally change who's impacted by it, and then more estate planning. I think one of the biggest things I continue to hear on the news and different things like that is, like, estate planning attorneys have been like busier than ever getting things drafted up just in case he's going to have the ability to do it. Right now he still can't because of the Republican Senate. They're not going to push it. But if something changed in Georgia come January 5th, you could see a lot of activity that potentially is going to happen with that. I think in my opinion, he's got a lot of other things on his mind. That we're still in COVID. There's still some different things there. So I think that's more pressing than some other stuff.
Anything to share with business owners before 2020 wraps up?
Yeah, I think there's a couple things I forgot to hit on, and I think a couple of final points as well. Right now there is a proposed new stimulus bill that's in that hopefully will get passed before the end of the year. In that, we believe, we still haven't seen all the details, but in that is the allowing the deductibility of those expenses against the PPP loan. So it wouldn't be picked up in the income. They would be deductible. So you wouldn't be picking. So if saying you had $1 million of a PPP loan, that $1 million wouldn't get picked up in the income. It would basically be flat. And so again, it makes it very difficult for tax planning, because if I don't have that $1 million and I don't have any issues with how it's handled with R&D or different things like that, I may be able to create some losses that we talked about earlier by switching from accrual-based to cash-based, buying some equipment or different things like that to take the depreciation and then be able to carry back and get more cash. So that, I think over like the last 3 or 4 years, it's been very difficult to truly tax plan because we're getting all this legislation towards the end of the year. So it really is still very important to have those conversations, to at least be equipped to say, okay, maybe let's make this decision, let's make that decision. We don't want to make any decisions that are going to impact owners the wrong way. But if we lay different things out, you have more scenarios to try to figure out what makes the most sense to be able to best consult with your clients. And so I guess the last thing I would say is, as you mentioned, it's December 10th today. You really have most likely until the end of the year, right? Because there's not a whole lot you can do after the end of the year. But take a few moments to at least think about what maybe you could do. And really, if you need to, reach out to your current tax advisors. We'd be happy to have discussions with you as well, point in the right direction. But there are huge opportunities to really help try to generate additional cash in your business so that you can reinvest that and continue to grow and hopefully get past this pandemic that we're in and have a successful 2021.
Well, that's it for today's episode of Talking Industrial Automation. If you're interested in learning more about Tim Finerty or Clayton and McKervey, you can find them on the Industrial Automation Exchange at www.csiexchange.com. Thanks for listening, and thank you, Tim, for joining me today.
Thanks for having me.
If you enjoy this podcast, please subscribe in iTunes, Stitcher, Google Play, or wherever you listen to podcasts. You can also help others find us by leaving a 5-star review and sharing your favorite episodes with colleagues. Thanks for listening to the Talking Industrial Automation podcast. Thanks also to bensound.com and Wistia for the music bumpers. Until next time.